Well, hello everybody and welcome. This is part 2 of the session on September 22nd, 2014. My name is Eva Patricu. We have our presenter Matt Haley. We had a session of about 35 minutes or so that was an introduction and housekeeping. So I would hope that people would listen to both, especially new folks who haven't had the chance to participate before now. All right, so before we go, as ever, our legal disclaimers that the information shared by community members is for informational purposes only. It is not meant to be financial or investment advice. The results described by any community member testimonials, they're not indicative of the results individual investors may generally expect to achieve. Neither investors nor any other third parties verify the truth or accuracy of any results or experiences described in community member testimonials. Remember that trading is risky and can result in losses, and the losses could exceed the amount invested where any form of leverage or borrowing or margin is used. So any information that's shared by community members, it may not be appropriate for everyone because not everybody has the same level of financial sophistication, situation, time horizon, risk tolerance. It is just general information, and none of it is meant to be investment or financial advice. Each member is an adult, as Matt says, and therefore is responsible for conducting his or her own analysis on particular investments and making personal investment decisions. Under no circumstances can any member of this community or investors or any of their affiliates be held responsible for a trading decision made by another person. I hope that that is loud and clear to everybody. And as Matt said earlier, everybody here is a volunteer. So whatever we do, we try to help. We want to help each other, but we don't do it because we don't, for accepting risk. We do not accept any risk. Okay, Matt, let's get started.
We accept no risk and we accept no money, so it works out just fine. All right, so as Evie says, I hope you watched the first session or the first half of this session to get all the background, and let's get started. As soon as my machine decides we can. All right, so we're going to be talking about diagonals. Diagonal is made up of a couple of different kinds of option spreads, which you may or may not already know real well. Most people know vertical spreads, bull put, bear call, bear put, bull call, bull put, all the basic verticals. You can combine the verticals into an iron condor. You can combine it into a short iron condor, all kinds of different things. Time spreads, or sometimes called calendar spreads, use the same equity, just like a vertical spread does, but instead of where a vertical uses two different prices or two different strikes for the same month, a time spread uses the same equity, the same strike separated by time. So in one case, you have the same time and different strikes. We call that a vertical. We call it a calendar spread if it's the same equity and the same strike, but they're separated by some number of months in time. A diagonal spread combines those two. So we're still using the same equity, but the strikes will be at different prices, and the expirations will be in different months. So vertical differs by price, time or calendar differs by date, diagonal differs by price and date for the strikes. Graphically, that looks like this. If I have time on my x-axis, price on the y-axis, a price spread or a vertical would have a short and a long, or a long and a short based on where the ticker is. A calendar uses the same strike price but differs in time. And a diagonal has a short at one price and a long at a different price. And this just as easily could be aiming down if it's a different kind of diagonal. But all we're trying to show is verticals, horizontals, or calendars, or time, and a diagonal. And we'll go into the rules for each of these in just a moment. But at a basic level, is everybody familiar with or feel comfortable with those spreads? And I will take
Is there
silence
anybody who has never traded a time spread of any kind? Now, I'm not seeing anybody say yes to that.
Okay. Well, and if there are, that's okay. If I recall, Corinne may not have yet, but we're going to cover everything we need to cover. So let's dig into these a little bit deeper. Whoops. Whenever you do a spread, especially a vertical or a diagonal, and in many cases, even in a calendar, but you try and manage that in a calendar, but certainly in a diagonal and a vertical, believe it or not, you want to lose money on one side of the spread. For those of you that are new to diagonals, this will bother you. People will try and make money on the short and the long. And when you do that, you make less money than if you were to actually lose money on your short. You want to lose money on your short. In a vertical, you want to lose money on your long if you're selling a vertical. In a diagonal, you want to lose money on your short. If you overtrade, if you are trying to constantly manipulate it so that you're making every potential penny that you can draw on a whiteboard or on your white pad of paper, then in reality, the only people that will make money is your broker, AMTD is Ameritrade, and the market makers. You will probably not be able to outtrade the professionals. You can outinvest them, but you probably cannot outtrade them. If you're a vertical trader and you replace the long by moving further out in time, you've created a diagonal. The trade is more theta positive, but obviously it takes more capital. And this is a case where you are doing a gamma and theta trade, even though you may not think about it that way. You're reducing your gamma risk, you're increasing your theta, you're increasing your vega risk. So by moving one part of a trade, you affect at least 3 of the Greeks. In most cases, when you move out, you've also increased or decreased your delta, and so you've actually, keeping the exact same strike, changed all 4 of the Greeks. If you go out a year, you've actually decided to bring rho in, and most of you don't even remember how to calculate rho, let alone use it on a daily basis. But a year from now, interest rates are higher or expected to be higher than they are today, and so there's a time cost of capital. And that's one of the reasons on very long trades you'll see puts and calls react very differently, because the cost of carry for your counterparty needs to be taken into account. So any kind of movement in a spread of any type, whether I change in a vertical, make it shorter or taller, I change all the Greeks. If I change the time, I change the Greeks. If I'm changing both, obviously I'm changing all the Greeks, which is why next week we'll spend some time on the Greeks. And I believe and know that you're all confident that you remember all the Greeks. I'm also confident that a little bit of review won't hurt anybody. Okay? If you do 2 short diagonals, so here we took a vertical, moved one leg, and we've made it into a diagonal. If you do 2 of those, you'd end up with a double diagonal, and it looks a lot like a short iron condor, which, if you'll notice, I say the word short. Whenever we talk about iron condors, we almost always are talking about short iron condors. But for some reason, we always leave the word short out, and that's why when you're looking at profit graphs for iron condors, they look the opposite of what you think. It's because we sell iron condors, we don't buy them. And the last part of this strategy is, if you watch the Greeks on a daily basis, you will drive yourself crazy, and it's about as useful as watching your P&L on a daily basis. You should never do that. It's just bad. I'm going to repeat it. There is nothing more dangerous to your mental health and your net worth than watching your daily P&L. If you are with a kind of person that wants to do that, please let me know, and I will be your counterparty. Meaning, I will take the other side of your trade if you want to trade like that. All right? If there's no questions, we'll move on and go into this in a little more detail. So I think almost everyone is familiar with the covered call. That's where you buy the long equity and you sell a short against it. It decreases your risk minimally, but it does provide income. When IVs or implied volatilities are a lot higher, it actually acts somewhat as a hedge. But with IVs as low as they are now, it doesn't really do that much. Covered calls are a fine technique when you are when you own the stock, and you have to be careful when you own the stock that if you've owned something for 16 months or 12 months and a day, and you're selling covered calls against it, you have to make sure that you don't get called out because you may end up with a tax issue that you weren't expecting. If you hold something for more than a year, it's gone into the long-term capital gains category instead of ordinary income. You may double the taxes if you get called out. Covered calls are typically thought of as a way to juice a little bit of income out of an investment that's a long-term investment. If you're trying to do something shorter term, the profit chart for that looks exactly like a short put. The advantage of a short put is the margin hit on a short put in a marginable account is about a quarter as much. So you can do 4 times the investment, and the broker will let you do that. And if you're doing 4 times the investment, instead of getting 1.25% a month, you might be able to get up into 6% per month. Your trading costs should be the same. You may decide to move even a little further out of the money and decrease your risk. So you could increase your returns, decrease your risk, but be taking margin risk. So you end up changing one risk into another. Does that make sense to people? I think everybody's familiar with covered calls and short puts. A diagonal, instead of buying the equity, you buy a long equity option. And just like in a covered call, you sell a short out of the money option against it. So a diagonal looks much like a covered call, but it takes much less capital because an option costs a lot less than the equity. And we'll show an examples of this in just a moment, as soon as I'm done with this slide, okay? So we can see it graphically instead of just in text. Covered call, as I said, looks just like a short put. Diagonal looks like a heavily margined covered call, but it has time risk. Unfortunately, many of us are familiar with using the Analyze tab in Thinkorswim. The problem is it can't handle time-based spreads. It can handle a short-term calendar, but it can't do the rolls on a calendar, and it can't handle diagonals at all with any kind of rolls. So it's unfortunate. It's this wonderful tool for doing verticals and for doing butterflies, for doing iron condors, collars, strangles, any of those kinds of things. However, it doesn't work for calendars and it doesn't work for diagonals. So think of a covered call as not having time risk simply because you own the equity. When you buy an option, it degrades over time. It has a theta decay, and therefore you're adding time risk. So I decrease my capital risk, I increase my time risk. And you're going to find that with just about every investment and trade in the world. You can get rid of one risk, but you're taking a different risk. And if you don't know what risk you're increasing, you have to believe, please believe me, you have to believe that there are no free lunches out there. There is somebody else, probably as smart as you are, that has figured out what you're trying to do, and there are no risk-free trades. Okay? All of these trades are directional. I said in the beginning that fundamentals and economics matter. These are all directional trades. You can either be delta negative or delta positive, and that means that you have to have your posture correct. All right, does that make sense to everybody? And we're going to, if it's okay with people, we're going to pull up a couple of option chains and take a look. Does that make sense?
Yeah, it's making sense. We're getting a few comments. Thank you.
All right. So I pulled up Amazon, and let's just take a, I think I have a chart here. Bring that up here. Okay, can everybody see this chart okay?
Yes, I can see it.
All right, I have the MACD and implied volatility as time charts. I'm a profits guy. Doesn't mean that that's the, you can certainly do everything I do in profits you can do in TOS, except when I do comparison charts or when I turn on or off dividends. But to be honest, pick a charting tool that you like, master it, and then be done. So here's Amazon. I'm sorry, here's the RUT. Let's go to Amazon instead. All right, so if I look at this on a 2-year chart, we had a nice ride up, we had a nice fall, and looks like we might actually be in, is this a pennant? I can never tell a pennant from a triangle, so you'll hear me asking people that are smarter than I am about the technicals. It looks like we're doing something that could break out one way or another. We were a long time ago in a trend that is clearly gone, so let's just delete that off the chart. So here's the kind of thing where you would not, unless you're a lot smarter than me, I don't see a strong trend here. I certainly would not be doing a diagonal on this because I don't know which way it's going to break or if it's going to break at all. I might decide that I could do a calendar here because, hey, in the short term, it looks like it's sticking within this little, is this a triangle, Evie?
Yes, it is a triangle. The triangle takes weeks or months. The pennant is a few days.
Okay, great. Every once in a while, I guess right. So we may decide that it's going to bounce up and through here, so you can't really do a directional trade. If you felt like you had to trade it, you might decide, oh, I'll do a time trade only on this, so I'll do a calendar. The problem with the ticker that's in the $400 range is if I look at Amazon and I go out roughly 4 months and I say it's going to probably go through 335, a 335 is going to cost $15.50 for that side of the trade. I'm going to collect just under $4. So I have a very expensive trade to put on. And what you're going to find for a lot of high-priced tickers, if the ticker price is high, the option price is going to be high. Doesn't mean you can't trade this very successfully and make a lot of money at it, but it does mean that you're probably only going to be able to do 1 or 2 or 3 contracts. And so you're going to end up taking greater portfolio risk. You're going to have fewer items in your portfolio if you trade high-price items. This is still tremendously cheaper than buying the stock, right? So if I were to do this calendar here from January, that's roughly, what, a $12.50 price. $11.50, whatever that is.
Yep.
So that means that
maybe.
$11.50, that means I'm putting in $1,000 for every contract. If I want to do 3 or 4 contracts, you know, you want to be able to commit $3,000 or $4,000 to this trade. You may decide that that's too expensive. If you are really, really smart and you know it is breaking out here, you're a lot smarter than I am, which isn't hard, but if you know that that's going to rise, then if I take that same, if I wanted to buy in the money, let's say something close to 60 delta, I'm only 4 months out and I'm still paying $25. It's $3.15, so I'm paying $18 of extrinsic value that I have to earn on this. So it's an expensive ticker to play with on that. You may find that another ticker, such as Accenture, I think this is one that's going sideways. I think it'll even come up. You can do it. There we go. This one is also going sideways, but because it's a fifth of the price, you'll probably find that if you're going to do a calendar, it's a lot less expensive. It's only $4 to get in at 77.5. If I wanted to get in at 80, because I think it's going to bounce up into the 80 range, an 80 calendar is only going to cost me roughly $1.20 after commissions to get into. Now I can do 6 or 8 contracts and still be under $1,000. So here I could use this ticker, which I still think is oscillating back and forth, going sideways, and I could do a time-based trade on it. But I still would not do a diagonal on it because I don't see a breakout. You're also going to probably see, since earnings is tomorrow, earnings are Wednesday, you're probably going to see that the IV skew is the opposite of normal. You're going to find that it's probably higher in the beginning. Yes, it is. So we have an IV of roughly 20 for the front month, and going out 4 months, it's only 17. And that's because earnings are coming real soon. So if it doesn't bounce on earnings, you should see this IV drop, and you'll get some Vega gain in this ticker as well because the IV is higher. So there's different ways that you're going to play with the Greeks, and we'll learn the Greeks a lot better. But these are not tickers for doing a diagonal on. GLD, however, it's pretty easy to see that this is in a long-term bearish direction. You can say that it is going sideways. You could say that it's breaking out of a triangle and going down. Maybe it's headed down to here. You may say that if it breaks through this level of support, the next level of support is pretty darn low. Let's see if we can find the next level of support. So here, it's probably down here. So if it breaks 115, you've got another $10, or roughly 9% drop for support. So you may decide that you're going to watch this and see if it comes through here, and if it does, then this would be a good ticker for doing a bear diagonal on. It's pretty hard to see SPY as in anything except an uptrend. If I look at a 2-year chart on a weekly basis, that's pretty clearly an uptrend. Take off the drawings. My 10-week is not even getting close to my 50-day is not getting close to my 200-day. I'm in weeks, so therefore a 10 period is 50 days, 5 days times 10. And the blue is 40 periods, so that would be 40 times 5 is 200. So there's nowhere close to a crossover. That's an easy trade to be in a diagonal on. So that would give a direction for a bull trade. Gold is down, therefore BHP is probably down. Oh, not so much. Oh, recently it is, though. Or you can think of that as sideways. But you're going to be looking for things that are in a significant trend down. Over the last few months, this is in a significant trend. Longer term, you may see that I'm not positive that it's going to break through here. And that's why you'll see me bounce back and forth from a 2-year chart to a 6-month chart. And very rarely do I go less than 6 months because I'm doing investing. I'm not doing a 5-day swing trade. If I was doing swing trading, 3 months would be a long term. In investing, 2 years is probably your long term. Okay, does that make sense for examples of bulls, sideways, and bears? All right, and I know that everybody knows all that, but I thought...
Yep. We encourage participation, folks, so please chat in, even if someone else has already said yes. It's nice to to get feedback, because if there are no dumb questions here. So if anybody is stuck on something, Matt or someone else, we can try and help you understand if you are stuck.
Yep. And I have no problem if I'm not saying it in a way that makes sense. Maybe Evie will, maybe Kit will. If Francois is on board, he might. There's a lot of people that can say the exact same content in different ways. So, all right. So bull entry rules. This is our diagonal. We're going to dive into the diagonal here for a few minutes. We buy the long option when the stock price has continued to trend up. This is a bull trade, therefore I want an upward trend. You can consider legging into the trend. For those of you that were in the session last year, you'll notice that I'm going to be doing more legging this year, simply because for this past year, especially the last 8 months, volatility has been down, but our trend has been pretty steady in most cases. Therefore, I'm going to be doing more legging. The market looks a lot closer to what it did in 06 and the first half of 07, as well as 09, than it does during 11 and 12. So as the market changes, we'll modify our rules slightly, but the basics of the rules don't change. So if you're going to leg into the trade, you'd enter the long side. You can either enter it right away, or you might decide that you're going to wait until it bounces from support. You have to be careful not to wait for a flag to get in, because it might go up 3%, then flag down 1.5%, and that means you lost 1.5%. It doesn't mean you got in at the bottom. It means that you lost money or opportunity cost because you didn't get in now. So make sure you're thinking through when you want to enter. I think of confirmation for an entry, if it's bouncing, if you're using the bounce off support, is 2 days. 1 day is not a trend. I know a lot of us like to go to a 30-minute chart, and then we see these long-term 4-hour trends. To me, that's not a trend. Then you may decide, if you're legging, to enter your short as the MACD rolls over. So you get in when it bounces and the MACD is rising, the stock price is rising, and then you sell your short as it perhaps enters into a flag period. Or, and this is what I do, when I see a good trend and I like the stock, I don't try and overtime things. And I know that in the short term, people will beat me. And on some long-term trades, people will beat me because they did a better entry. I find that over time, getting in puts more money into the market, and I do better over time myself. And it's not the way you have to do it, is if I see the trend I like, I get in. So that's a bull entry. Bear entry is just the opposite. Or you can think of just putting a negative sign in front of everything and using puts instead of calls. So you're going to buy the long put when the stock is trending down or the equity is trending down. You can leg into the trade by entering as it bounces off of resistance, and exactly the opposite. Again, confirmation is 2 days, or if you see a bad ticker in a bear market, then enter whenever you want. But you're going to be on a bear trade, you're looking for a bear trend. On a bull trade, you're looking for a bull trend. Do those make sense? Bull, stock is going up. Bear, stock is going down. Does this also hopefully point out why I could be bullish on some things and bearish on others? I could be bullish on SPY and bearish on gold, or bearish on commodities. I am bullish on the stock market right now. I am bearish on agriculture. I believe at some point it will bottom. I am not going to try and time the bottom. I'm assuming that since this is commodities, it will not bottom at zero. But there's no reason for me to get in before I see a reversal of the trend. Okay? There are a lot of commodities right now that are bearish. DBC is about half hard commodities and half oil, right? So it's pretty clear that that is not a rising ticker. If anybody sees this as a bullish trade, please let me know. I will be your counterparty. that all make sense? Pretty straightforward stuff. All right, so what do I buy? If I'm going to buy my long, since this is a directional trade, I want some delta on my side. I'm going to buy the long deep in the money. And it's not extremely deep. It's not, I'm not trying to buy so far that my delta is, close to 1, 0.75 even. I'm going to buy it at about a 0.6. And I'm going to buy it out roughly 5 to 7 months. I'm aiming for 6, but every strike, for every ticker, you don't have a choice of exactly 6. I would not enter a trade less than 5 months out, if I can possibly help it, unless I really see something that's great and I want to get in right away and I don't want to go out 8 months. I might be at 4.5 months right now simply because the 7 months out isn't available yet. But I'm looking to go out roughly 6 months. You can, if your posture changes, you can get out. You don't have to hold for the whole period. And like I say, I know I'm beating this to death. This is a fundamental trade, so do not buy against your posture. This is not the place to say, I'm going to hedge my, I think the market's going up, but I'm expecting, a pullback, so I'm going to buy a diagonal, bear diagonal. If you're trying to hedge, there are cheaper ways to hedge, and you will probably use either verticals. Right now with IVs being down, you could certainly use some put verticals or even just long puts, and they're pretty inexpensive. So this is not a timing trade. This is a fundamental trade. Does everybody understand the difference between fundamentals and technicals? I'm assuming everybody knows that, so chat in if you don't.
I think most people are saying yes, but is there anybody here who doesn't understand what Matt means? Let's see if we can get a no. And again, there are no dumb, that don't think that we're going to think you're dumb because you don't know, because you may have never thought about it.
Right. May have been something you heard once, and it made sense when Linda said it in front of the room, and it may not make sense when you get back to your office. All right, well, we'll go forward. So my long is 6 months out, and it's roughly a delta of 30. My short is roughly a month out. I personally try and stay at least 21 days out. You could modify these rules and say I'm going to sell weeklies, but then I end up taking gamma risk. And I don't like gamma risk. I also don't like having to watch the market all day. So I am buying at least 21 days out. Some of you will notice that this used to say 30 days. There are so many weeklies now on tickers that we trade that I don't mind going out roughly 3 weeks. And what I want is a delta difference of approximately 0.35 or 0.30. So I'm going to sell a short that's a delta of 0.24, 0.25, maybe 0.30. Maybe it's, and these are not hard and fast. To me, 0.32 is roughly 0.3. These are all, you've all heard me say this before, these are all crayon lines. I am not calculating this to the penny. On some tickers, I am not calculating this to the quarter, 25-cent mark. Right? These are rough orders of magnitude. And you're going to buy and sell what you can get, and if you can't find something that's useful, then you're going to find a different ticker. You may find that you buy the stock for some low-priced stocks simply because there's no easy way to do a diagonal on it. Or you may just buy the long call and put less money into it, whatever. The difference in delta provides you a lot of risk management. So if you're right and the stock moves the direction you want it to move, and we'll see this in the Greeks as we go through it again next week, but we all know that the delta of a short month, 21 days or 35 days out, will move much faster than the delta of something 6 months out. But since I have a delta difference of roughly 0.3 or 0.35, it has to move several dollars in the direction I want it to move before the short becomes a higher delta. So this is where if the market moves in my direction, then I'll lose money on the short and I'll make money on the long. But if I'm making 60 cents for every 30 cents I lose, that's a trade I'll take all day long. So your objective is to make sure that you're buying something that's moving in the direction that you fundamentally believe in. You're buying a fundamental stock, a strong fundamental stock, in a bull market, and you're selling a weak fundamental stock in a bear market. Do these Greeks make sense? And if I just pop into an example, I think everybody probably is familiar with the SPY. So let's go look at an example in the SPY. So January is roughly 4 months out. February is right on 5 months. March is right on 6 months. So if I were to do a trade entering one today, I would probably look at this March, and I'd be looking at, different, this is a 60 and this is a 60 to me. So either one of these is fine. Just to save 70 cents getting in, maybe I'll do the 194. Now I'm going to look at the chart to see, am I below some level of support at 194? 194, certainly below that level of support. It's way down here. So I've got one level, 2, maybe 3 levels of support. But I certainly have a lot of support below the 194. So I'd be looking at buying the 194, and then I'd be looking at selling something close to me in time. 18 days is a little too close. So I'd be looking at selling 25 days out, either the 201 or the 202, 201.50 or the 202. I'm not going to sell something that has 0 open interest. I don't care what the volume on it is. So I'd be looking at selling the 202. Then I'm going to come look at the chart again. Where did the chart go? 202 is right above a level of resistance. So that would be fine. I could also go out a little further in time and maybe go a little safer, like to the 202.50. Okay, so I'm going to be looking at something more than 21 days. And if you're typically going out a month, this might be where you're looking. 400 contracts is going to be fine the way I think of things, because I'm probably not going to do 100 here. And so this trade would cost me, if I do 25 days out, I collect 84 cents. It costs me $10.36 to get in. So that's roughly $9.50. But my extrinsic value, my intrinsic value is roughly $4. So I have roughly $4.50 of extrinsic value that I have 6 months to make up. I'm pretty confident in that trade. So that would be the trade that I might put on. If you've only got a couple $1,000 to put in, you might only be able to do 2, 3, 4 contracts. But that's the rough pricing for the SPY. Does that make sense from the example?
Matt, there are a couple of questions. John is asking, why diagonal rather than just a long call when your posture is bullish?
Okay. So if my posture is bullish, if I can make money, so you can certainly buy in the money calls. Absolutely. And to be honest, right now as this is trending down, I probably wouldn't buy this until I see it bounce off of wherever it's going to bounce, the 198 or wherever. But if I sell something that has a low probability of ending up in the money, I collect more. I make the delta on my long let's come back to here. Well, no, I guess we can use this. So if I buy the 194, let's say it bounces today. So today's not a great entry point, but let's say it bounces from here. And it bounces, and so the 194 is going to make 60 cents, right? Because it's got a delta of roughly 0.6. It's going to make 60 cents for every dollar. But if it's going to come up and hit this resistance, I may find that it consolidates around that resistance, and so I collect theta, excuse me, for a long time on that. Even if it goes through the 202, that 202 is going to still be decaying. So it'll rise in value because of delta, but it's rising from 0.3. So on a long term, I end up making more money because the probability of the short ending up in the money is only roughly 30%, and I still will be making money all the way through that point. So the break even on this, on a 25-day trade, is 202 plus 83 is 202.83. Now that's not actually the break even. That's where this is going to start to, it would have been worse to have taken the trade. 202.83 is up in here. So if I were to hold this all the way to expiration, it would have to break through 202.83 for it to have been better to just buy the long call. If it comes down, I have some protection because I'm getting that 83 cents, and if it keeps coming down, that 83 cents will degrade very rapidly because of theta and delta. So it's increasing my probability of success, but it is increasing the risk that I won't make quite as much money. I have an opportunity risk cost, but I put the probabilities in my favor on an investment. Does that make sense, John?
Yeah, he says he got it. Thank you.
And I know next week, 5 minutes in. Huh?
Yeah, next week we're going to have a more thorough discussion on the Greek. So I think you can, you're going to go through that in a little bit more detail and explain why these things are important.
Yeah, I go back and forth. Should I review the Greeks first, or should I show the trade, and then when we go through the Greeks, it makes more sense of why you care. So this is the way we're doing it. And next week, hopefully this will all be intuitive. You said there was 2 questions. I don't see another one.
Yes. Yeah, it came privately. So this is from David. It says, choosing the monthly expiration date often gives you more volume open interest. Does this matter? Not quite sure I get the question. Do you, Matt?
Yes, because if I look at some weeklies, the open interest is pretty low. On a lot of tickers, it's extremely low. The monthlies will always be higher for the strikes that have existed. Some of these strikes are brand new today, and so if I change to volume, we'll see volume on strikes where there's very little to no open interest because these have just been created. But you're absolutely right. Strikes that have existed for long periods of time will always have more volume to them than these intermediate strikes or the weeklies. What I find is, here at 18 days, it's on the SPY especially, you've got quite a bit of activity. But if you were to go to XLE, I'm just going to pick one without knowing. You'll see these, and again, you can ignore the 0.5s. So 200, 400, 700, 800, 2400 versus the weeklies, 10, 80, 5, 20, 20, 5, 60, 20. So that is absolutely right. I would avoid the weeklies on low volume or on low open interest tickers. On SPY, I'm not so concerned. On XLE or XLV, same kind of thing is true. So I'm agreeing. That was David, you said? Or Dave?
It was, yeah.
I agree 100%, and it does matter. If I'm going to do 5 contracts, I don't want to do 5 contracts on something that only has 50 out there.
And you probably noticed that Matt said that sometimes he will pass on a trade, even if he likes the ticker, but if the options won't work, he would pass on it.
That is absolutely correct. There are roughly 3,000 choices. There's probably only 400 or 500 good trades a day that you can make. Pick one of the 400 good ones instead of one of the 2,500 bad ones.
Yep.
And I would challenge anybody that says, I can't find anything to trade today, to please try a little harder. All right, so that's an example, and I'm not expecting that after today you go out and do a lot of these trades in real money, but that delta difference provides you gamma risk abatement, or it helps you avoid gamma risk, and it increases your probability of making money, and it increases your total profit, but it increases your risk of an opportunity cost. It also lowers your capital investment. So those are the kinds of things that when we get to the risk period or the risk presentation in a few weeks, those will all come up as obvious things, okay? Any other questions before I move on, Evie?
No more questions at this time.
All right. So let's say the trade's working, and we will do what it's not working in just a moment. If the underlying is trending in your direction, you can, if you've legged in, you can leave it uncovered. If it bounces off of resistance, and I say 2 days is a bounce, then you could put on your short. You're going to review your long to see if you should roll, and we'll talk about that in just a minute of what does that mean. When the delta grows, so if it's moving in your direction, the underlying is trending in your option's favor, then your delta will be going up. At some point, you can roll from a delta of 0.66 to a delta of 0.59 by moving closer to the money. That frees up cash that you can either put back into the trade and get more contracts, or that you could put into some other trade. Or you could put into more time in this trade. You may find that it takes 2 months, so you buy something that's 6 months out. 2 months later, the delta has gone up, but you want to buy those 2 months back, and so it's provided you the money to do that. So you can either buy more time or more contracts if it's moving the direction you want. You can sell new short options when you do that. Sometimes what you may do, and you'll see this when in my real trading, I may have 4 contracts at a strike of 62 and 2 contracts at a strike of 60 because that's all I could roll. But when I increase the number of contracts, it means I can increase the number of shorts as well. So that's additional cash that can either come off the table or go back into the trade. You're going to find that when your delta gets to approximately a negative 0.7 on a bearish trade or 0.7 on a bullish trade, that you can absolutely do the roll. You can, like I say, either go out in time or add contracts. I would suggest that you don't get your trade less than 100 days. You're going to find that the profitability is great on a 100-day trade, but your risk has gone up tremendously. If we have a pullback, if it takes 6 weeks for a long-term pullback and then 10 weeks for it to recover or 6 weeks to recover, and you only have 3 months, you're going to be at break even. You're going to lose money on the trade. If you had 6 months, so you had 26 months in time, and you have a 6 month down and a 6 weeks down and a 10-week recovery, you still have 2 more months for this trade to become even more profitable. And obviously you will have made money on your shorts along the way, but you'll have lost money on your long, but you still have time for this trade to work. If you cut it too short, then you have to be right not only on direction, but the exact timing. And if it's moving in your direction, you're going to find that your tendency is to always add more contracts, but in many cases you should add time. Does that make sense to people?
I think it will become clearer when we try to look at examples.
Yes, it probably will. All right, trade management. Now, just as important, or perhaps more important, if the trade is not working, if it is going against you, The most important thing is you have to determine if your posture is wrong. But if you believe long-term in the posture, but in the short term the trade's not working, you can roll your shorts closer to the money and get a little more cash along the way. I would not invest it back into the trade. I would just roll the shorts and take some cash off the table. So if you've sold something for 80 cents and it's now worth 15 to 20 cents, somewhere in that range, then roll. If you lose a third of the value, so very, very quickly in a couple of days, or if the price point, the strike value is down to a dime, then you need to roll again. There's no theta in something that's got 15 days left and it's only at a dime, right? The theta calculation will say there is, but you know it's going to be a nickel or at least 3 cents at 3 o'clock on the last day, so you really only have 7 cents and 10 or 15 days to do it. So don't be selling or holding shorts at a dime. So this is, if the ticker's moving against you, then roll your shorts down and think about whether or not you're wrong. If the short delta goes above 65 or gets really close to your long, roll it down. Your trade is not working, but it's because you've made a bunch of money and you've made as much money in this trade as you can. It's okay for the delta to go up. It means you've made money. It means the trade's not working right now, but it was working until now. You're making money. Please do not panic. New diagonals traders will quite often post that, you know, I lost $1 on my short. How much did you make on your long? I made $3 on my long, but I lost $1 on my short. That's a good trade. Okay, so something could be working for a long time and then stop working. You still need to do something. All right, rolling your long. And I said this a moment ago, but here's how you do it. You're going to be managing both components of your long, the time to expiration and your delta, or the strike price, however you want to think about that. You always want to keep at least 3 to 4 months. 100 days is the bare minimum, I would say. After you've been doing it for years, you may decide that your bare minimum is 85 days or 87 days, and that my rule of 100 is crazy. That's okay. Make whatever rule you want. You'll see me sometimes break my 100-day rule, but it's pretty rare. When the delta grows to an absolute value of about 0.7, you can either roll out in time into a delta closer to 0.6, or you're going to roll down to a 0.6, stay in the same month, and get more contracts. If you have 3 or more contracts, what you're going to find is that you'll end up with more contracts and a total higher delta. And we're going to do some examples on this in just a moment, because reading this is one thing. There's a lot of people might get it all from the text, but sometimes seeing some pictures helps. Or you may find that you get more months with the same number of contracts. If you get more contracts, remember to sell more shorts, because that's, I'm not going to call it free money, but it is money in hand. And money in hand is always better than money not in hand. All right, let's go look at a couple examples, and then we'll review some homework. Is that fair?
Yeah, that sounds good, Matt.
So let's look at the chart for SPY. And this has been in a long-term uptrend. It's pulling back right now. Excuse me. If I had sold a short, let's just take a look at a couple different things. If I had sold a short up in the, when this was coming up, maybe in the 204 or 205 range, today, and time has passed, so now it's up, I've only got 11 days. It'd be good if I actually got to the right ticker.
Hey, Matt. Yeah. Thank you.
Minor details. Sorry about that. So So let's say I sold a short in the 204, 205 range. It may have been worth $1 when I sold it. Today it's worth a nickel. I should have bought that back earlier. 11 days, anything that's down in this range, 203 or higher, I should be buying back and rolling with 11 days. You know that the basic rule InvestTools teaches is 4 to 10 days. If I've got something that's only worth a dime and I've got 11 days, you know, and I've said this before, that your weeklies, you know, here's 203, here's something 4 days out, 203 has still got 2 or 3 cents. A week later, the 203 has 11 cents. So you can make roughly a penny a day by holding on to that short. That is certainly not a worthwhile thing to be doing. You should be looking at rolling out perhaps to 25 days. And even if you thought that the 204 was the right place or the 203, you're rolling that into 40 more cents. You're going to find that the realistic theta, the number of dollars you make per day, will be higher on something here, even at the same strike. And again, we're going to talk about this a lot more next week. But if I pull up the theta on something 25 days out at 203, it's 2 cents. At 4 days, the 203 also says it's 2 cents, but 2 cents times, 4 days, I can't be getting 2 cents, theta. 1 cent a day is all I'm going to get. I'm sorry, I had the wrong column. Theta, 1 cent a day. Wish this tool worked a little better. 203, same strike price, further out in time, higher theta. Why is it a higher theta? It's because there's a higher delta. So time affects the delta affects theta. Okay, and I know that we all know that theta is higher the closer you get to expiration, but it's higher for the same delta. When the delta changes, so does the theta. And that's what we're going to really spend some time on next week, okay, is to make sure that everybody really understands that, the rules we learned, we have to make sure that we understand how the Greeks work together. Many people will say that the theta is higher the closer I get to the expiration, which is true, but what they forget sometimes is to say for the same delta. Does that make sense to everybody? All right. So if I were to put on in this trade, let's say I had this trade on and it was, say I had a January at 116 days out, and let's say originally I had a 190. Let's just show an example of rolling something. Is that all right with people? So I could roll from here to here. I could go from a 190 to a 195. 190 to 195. That would take delta from 70 to 60. Let's take a look at this a little better. So 190 has a slightly higher implied volatility, not greatly different, but it has a tremendously different price. 190 is at roughly $12. This is roughly 814. Let's call it 815. So there's enough open interest that I'm going to probably get close to the mid, even if I have to wait a few hours for it. So if I do that roll, I free up $3 and roughly 85 cents. So for every one of these contracts, I can take $3.85 off the table. If I have 3 of these, I can buy another contract. So if I had 3 of these, I'd have a delta of 210. But if I move to 4, I'll take money off the table and I'll have 240 deltas. and I'll have the ability to sell another short. Does that make sense for why you would roll along from 190 to 195? To make this easy to calculate, we actually have a tool on the website. I should have had this already running. I apologize, but
there's a link to it on the website right under the section I showed you with important information. There are 3 or 4 documents there. So one of them is called I think it's called a roll calculator.
Right. All the roll calculator does is that subtraction we just did in our head. So there's, all of you can do this without having the roll calculator, but we have it just in case. So if I had, this was the SPY, and this is how we use this little tool. And if anybody wants to make it even cooler, that's more power to you. It's published. All I ask is that if you play with it and make it better, that you post it for other people to use. You put in the ticker, the old price, or the old strike, the new strike. I'm staying in the same time right now as the example. So under price, you put in the old price, which is $11.98. I'm going to round that to $12 because that's roughly what it's going to cost with some commissions. And my new one is going to be roughly $8.15. This I should actually roll the other way, right? $11.95. So I'm going to make a little less. I'm going to be very conservative when I set this up. My strikes are 0.7 and 0.6. Excuse me, I'm about to cough here. All right, so that's real complex, right? Old strike, new strike, old price, new price, old delta, new delta. What that tells me is that I can get 4 contracts, calculates the number of contracts you're going to get. You're only going to have to fill in what's in yellow. Input values are yellow, calculated are blue. Went way out on the limb here to name those things. So my old strikes was, delta was 210 at the old strike. Deltas at the new strike's 240. That's if I truncate, if I only do 4 contracts. If this had come up to 4.7, it would also calculate it with rounding the strikes. But now rounding and truncating is the same. So I end up with 14% more deltas. But what's interesting is I take 9% of the dollars off the table and I get more delta. That's why we do the roll. I have less capital at risk for more potential gain.
Matt, would you be able to change it, assume you have 4 at the moment, and then we can see on the tool?
Now it takes me to, that's great. So now it takes me to truncated. I still end up with more. I start with 4, I end up with 5. My delta goes up a little bit, but I take 14.5, call it 15% off the table. But if I put a little bit of capital in and go up to 6, I go from 280 to 360. So I go up by 28% more deltas, but it only costs me 2.5% more money. So I would put cash into it. So if it's directionally moving in the direction I want, I'm obviously going to put in 2.5% to get, roughly, let's call it 3% more money to get the potential of earning, more than 25% more. That's a great trade. You could also decide that, what, now is the time to put in and move out in time. So let's say I was going to go all the way out to March. Now I'm going to probably move to the 194. And here I'm going to get 2 extra months, but I may not be able to get any more contracts. So I'm going to go out in months. So I could round and get up, but this is the 194. further out in time. So I would end up with fewer deltas by roughly 14%. I would take roughly 13% off the table, so it's almost a direct swap, but I'm buying 2 more months of being able to sell shorts. So for some of you, that might be the perfect trade. If it's trending the direction you want and you've been selling shorts against this, you might have been banking some money along the way. You decide, you know what, I'm going to move up and put in the difference and buy 1 more contract. Put in another $6. And I'm going to go to 300 so I can buy more. I'll get more time and more strikes. So this tool isn't going to tell you what to do. It's going to give you some numbers to help you make that calculation. And after a while, you may find that, instead of doing 4 of these contracts, you're up at 17 contracts. And now all of a sudden, you're moving from 17 to 19. Truncated, you're still going down a little bit. So, I'm down $4. I'm taking a little bit of money off the table. So you're going to see different kinds of calculations. But this is for going out 2 whole months. You may decide, you know what, I'm only going to go out 1 month. See if I can get an extra one without having to put so much in. Let me play with 1 month. And now I'm looking at, again, the 194, but now it only costs $9.75. Now I move from 17 to 20, and even with truncated, I end up even, slightly higher, but even. But I'm taking some money off the table. So this tool is to just try and help you play with these strikes to see what you want to do when you're doing the rolls. Does that make sense to people? And the only way to figure this out is to play with it. Don't try and do it all in your head. I bring the tool up because it helps calculate those percentages for you. And again, you can extend this to try and figure out how many dollars you're freeing up, etc. Okay? Does that make sense? So what we've done today is really focus on what we're trying to accomplish this year or these next few weeks, as well as some rules for the diagonal trade. Next week, we're going to really pound on really making sure we master the Greeks. Because if you know the Greeks, then you can do any kind of option trade you want to do. Everything I teach around portfolio and everything else will only use stock. We might occasionally end up with a short put or a calendar, but primarily it's going to be stock and diagonals. And then in my portfolio, you'll also see a couple of verticals that I use for some risk management. But if you understand the Greeks, then you can calculate and put in any kind of trade you want to put in. Are there any questions from what we did so far?
There were some questions, but I think we managed to get them answered between your explanation and some of the chat.
All right. Well, then let's move on to the homework.
Yay. 20 minutes, you said, right?
I said 20 minutes. And I said 20 minutes because this took me 5. So I did a multiply by 4. And that probably means, because people have accused me of being optimistic in the past, that this will certainly take you less than an hour. It might take more than 20 minutes. And what I would love you to do is, before your small group gets together, try and do the homework. And then if you can't, talk about it in your small group and then try and do it afterwards. Please do the practice. Please do the practice. The only way you're going to get good at anything is to practice. So I would pick 3 trending tickers, and you're going to paper trade them. So to understand how much capital they take, set it up with a covered call, set it up with a short put, set it up with a diagonal. If you are doing a trending downward, you can short the stock and sell a put. It acts just like a covered call. You have a covered short. and all the arithmetic is exactly the same. So just because something is going down, don't tell me you don't know what to do with it. You can sell the stock, and you can sell puts, etc. Okay? And instead of doing a short put in a downward trending, you would do a short call. And you're going to see the risk and your margin impacts of doing that. And then put on a diagonal. Then look out and say, what happens if this goes the direction I want it to go in 10 days? And I said increase. If you've got a downward trending ticker, then obviously this would be a decrease. We just reverse these. Then what happens if it moves a lot faster? 5% in 10 days is actually a pretty rapid move for most things. Then what happens if it just slowly moves? It just grinds in my direction for 25 days. So here is, a pretty substantial move. Here is a rocket, and here's something closer to the norm. Then do the negative trade. What if it goes against me by 2% in 10 days? What if it goes against me 5% in 10 days? Then for the ones where it's moving in the direction you want, see if you can figure out what strikes you would roll to. So if you haven't done them before, to make it easy, I would pick 3 bullish tickers. Don't make this so hard that you're spending all your time trying to figure out what's going on. If you've been through the sessions before, or if you've traded a lot, excuse me, do some bulls and some bears. If you really want to test yourself, do one that is trending sideways, but you're going to bias it, do a delta bias on a side trending stock. If that sentence didn't make sense to you, don't try and do it. Okay? It's something that 3 weeks from now will make a ton of sense. Today it may not. But pick 3 tickers, set up a couple of trades, and then just figure out what you think will happen. Then put these in, enter these in paper, write down what you think will happen, and then over the next few weeks, see if what you thought would happen actually happens. And that early slide, I said a lot of people spend more time talking and reading than analyzing their trades. We're going to set up, if you do these 3 tickers and do them 3 different ways, you've just set up 9 trades to monitor over the next month. Okay? Does that make sense to everybody?
And I know some of the groups have set up paper accounts so you can share your trades with the whole group and put them in those paper accounts as well. And then you can learn from each other. And some of the people who have been around longer can help you along the way as well.
Right. And for some of these people, and I won't throw out names, I was about to, but for some of these people, this is going to be, as a 5-minute exercise and you know it. And that's great. And for those of you that this is a 5-minute exercise, think back to the first time you tried to do this and remember that it probably wasn't a 5-minute exercise the first time. And, help anybody that is spending 20 or 30 minutes on it and just can't quite get there, okay? Are there any other questions? I hope this was what people were hoping that they were going to accomplish today. For you long-termers, I appreciate sitting through the review for the new people and everybody being ready. Hope there was even some new facts even for those of you that have been through this before.
Yeah, there are no more questions. I'm sure there will be. I will post the recording very soon, so I suggest you actually go ahead and listen again if this is the first time, and again and again. Why not?
And all the slides are posted. Obviously, the examples are not. The examples are embedded in the recordings. If you have never watched recordings before, you'll need to download the ARF player, or the ARF player.
Very true.
And the instructions are on the site for how to do that as well. Evie's done a great job of setting everything up. You'll notice that you never see me doing infrastructure, and that is because we want the infrastructure to work. So
it doesn't always work when I do it either, but we try, and we're here to answer any questions. I appreciate everyone. So thank you all, and we will see you online and see you next week as well.
Right. I'm going to give everybody a heads up. I think everybody knows this, that I do a fair bit of volunteer work. If I am not going to be here next week, that's the only week that I see out of the next 6 weeks that I might have to miss. I will let everybody know way in advance. And even so, if we don't do the Greeks next week, it might be a great week for people to go through some of these homework examples, even if I'm not here. So I will try, and I will probably know by the close of business on Wednesday if I have to miss next week. And I apologize in advance for that, but I always put my volunteer and family time ahead of everything else. So family first.
But this is part of your volunteer, Matt. What are you talking about?
You know, I may occasionally get overcommitted.
But I will not be here next week, so I'm trying to make arrangements for someone else to substitute. So you will hear what's going on by the middle of the week. All right. Well, take care, everybody, and we will see you soon.
Thank you very much. And please, any issues, post them. We're online all the time, so we'll either Evie or I or Luis or somebody will get back to you right away. There's a lot of very helpful people here.
Sounds good. Take care, all.